morning, good afternoon, and good evening. My name is Raja Mukherjee, and welcome to my channel. Once again, the Value Creation Playbook. Thanks for tuning in. And today, in episode 22, I sometimes wonder we have managed to complete 22 episodes in a short period of time. Thank you so much for your support. Coming back to this particular episode, we talk about ESG and its role specifically in EBITDA improvement. Essentially, how sustainability drives business growth for all of us. Let's dive right in. ESG isn't just about doing the right thing, it's about doing the smart thing. For years, sustainability sat in the corner of a boardroom, treated as a compliance task or a branding exercise. But that's changed. Today, ESG is a lever for growth, resilience, and profitability. Boards are asking, how does ESG drive EBITDA? Investors want to know, what's the ROI of decarbonization? And employees, especially the next generation, Gen Z, are choosing employers based on purpose. In this episode, we'll explore three pillars: how ESG boosts EBITDA, how Scope 3 emissions unlock supply chain value, and lastly, how investor-grade ESG metrics shape valuation. And what's in store beyond 2025 regarding sustainability as long as it relates to the business strategy it's supposed to drive. Let's talk about turning ESG into EBITDA. What's the business case? Let's talk numbers. Most companies still treat ESG as a reporting exercise. But when ESG is embedded into operation, it drives real financial outcomes. On the revenue side, sustainable products command premium pricing. Think of green financing, circular economic offerings, or low carbon materials. These aren't niche anymore. They're reshaping demand. On the cost side, ESG drives efficiency. Unilever saved over $1 billion by investing in energy efficiency and reducing emissions. Mahindra's Haryali initiative cut energy intensity by 14%, lowering cost and boosting investor trust. So the question isn't can ESG drive EBITDA? It's why aren't more companies treating it like a growth lever? That's kind of the direction that we need to move to really understand what's good for the organization from a bottom line standpoint. Let's shift to the top line. ESG as a revenue engine. Consumers are voting with their wallets and they're voting for sustainability. Nielsen said 73% of the global consumers are willing to pay more for sustainable products. This is not a trend. This is real pricing power in your hands. Tesla is a textbook example. Its entire brand is built on clean energy and sustainability. It's not a feature, it's the basic foundation of the organization. ITC's Papercraft or eChopal initiative show how ESG can create real rural impact while generating sustainable margins. Always remember, when ESG aligns with innovation, it doesn't just support growth, it creates new categories: green bonds, sustainable packaging, low carbon construction. Guys, these are $1 million markets in the making. All you need to do is to take that initiative. On the other side, let's also start talking of ESG as a cost efficiency engine. Essentially, the bottom line. ESG isn't just about growth, it's also about smart cost management. IKEA saves about 15% in energy costs by transitioning to renewables. They now own more wind turbines than stores. That's an amazing metric to remember. Infosys achieved carbon neutrality ahead of schedule by investing in green campuses and smart business systems. And those investments pay back every year to your bottom line. Think of ESG as an operational excellence with a sustainability lens. Lower energy means lower operating cost. Less waste means fewer inputs. Smarter logistics simply translates to higher margin. These aren't environmental wins. These are EBITDA wins, and your CFO will definitely be happy. Let's talk of the scope 3 emissions, which I sometimes say is the hidden giant in this entire ESG narrative. Scope 1 and 2 emissions, the one that you control directly, are just the tip of the iceberg. Scope 3 is everything else, your suppliers, your logistics, your product usage, and it's massive. For most organizations, Scope 3 accounts for 70 to 80% of the total emissions. That is where, my friends, the real transformation lies. Managing Scope 3 isn't about control, it's about collaboration. It means engaging suppliers, co-developing sustainability goals, and embedding ESG into procurement. It's not easy, but it's essential. Because if you ignore Scope 3, you're ignoring the biggest source of both emissions and opportunity. Let's now talk about the supply chain angle. And the way I see this is just isn't an operational backbone, it's a treasure chest for you to uncover, discover, and drive sustainability over a long period of time. Let's talk of Walmart's project Gigaton. And this is a great example. They're working with suppliers to eliminate 1 billion metric tons of emissions by 2030. That's not just good PR, it's lower logistic cost, better vendor reliability, and stronger brand perception. Tata Steel, working with certified suppliers to reduce raw material cost and carbon intensity. Marico partnered with packaging vendors to cut plastic waste, plastic usage by 25%, saving money while hitting ESG goals. And of course, ensuring that the P&L line around this entire cost becomes a lot greener. When ESG becomes a shared goal between a buyer and a supplier, it transforms the relationship from transactional to strategic. I think that's the goal that every chief operating officer, the CEO, or the CFO should aim for. And this has multiple ramifications into this entire business ecosystem, which is all about taking your P&L northwards and not southwards. Essentially, what does it talk about? It talks of circularity. That's a supply chain advantage. The old model, make, use, dispose, is dying. The future is circular. Companies that embrace circular supply chain reduce raw material dependency, minimize waste, and boost brand equity. That's a fantastic additional layer to this entire exercise. Patagonia leads the way. Recycled inputs is over 70% of its product. Tata Motors similarly exploring on EVs. Circularity is not about only the good for the planet, it's goods for your cash flow. Reuse, return logistics, recyclability, these unlock hidden capital and protect against commodity volatility. A circular mindset, the way I see this, friends, is the ultimate hedge against disruption. We have seen one 3 4 years back, COVID. Let's not hope we have one more, but this is the ultimate hedge that you have. But essentially, how do I measure all this scope 3? You can't manage what you don't measure, and scope 3 is notoriously hard to quantify. But best in companies are cracking the code. They're tracking emissions per supplier, carbon adjusted cost savings, and full life cycle emissions. Hindustan Unilever uses a carbon accounting system that maps supplier level impact. That means real time tracking, better risk management, and smarter negotiation. Measurement turns ESG from storytelling to strategy, from CSR to numbers that make the CFO happy. Now let's talk of investors. And that's where we need to worry of investor grade ESG metrics. ESG isn't about just ethics, it's about economics. BlackRock integrates ESG scores into every investment decisions. Companies with strong ESG performance enjoy better capital access, lower borrowing costs, and higher valuations. In India, ESG mutual funds are growing 3 times faster than traditional ones. Infosys and HDFC Bank are favored in ESG indices for transparency and governance. So, in a nutshell, ESG is a valuation multiplier. It signals discipline, future readiness, and resilience. And of course, investors are happy, and accordingly, they reward you and the organizations. Now, let's come to the brass tacks. What do we measure? So, that's what the ESG metric toolkit is all about. On the environmental side, emission intensity, renewable energy mix, waste and water efficiency are good 3 metrics to start off with. On the social side, workforce diversity, safety records, employee well-being, community impact are 4 key ones. On the governance side, of course, board diversity, executive pay alignment, ethical conduct, and anti-corruption systems are the 4 key ones that you should start thinking of right from day one. ITC sets the bar in India, linking environmental goal to business outcomes like farm productivity and waste reduction. The goal isn't perfection, it's progress. ESG matrix should evolve with the evolving strategy of the organization. Now let's link to valuation and the capital access. Let's essentially connect the dots. ESG isn't just about doing good for the organization, for the neighborhood, and for the planet. It's about being investable. Companies with high ESG scores enjoy 10 to 15% higher valuation and at least 20% lower cost of debt. Why? Because investors see them as organizations who understand and are really worried of the 3PL: people, profit, and planet. So it's not only profit that are worried of. Let's take example, Tata Power's green transition attracted long-term capital. Microsoft's carbon neutrality boosted investor confidence. And how do I translate all that matrix into a language that the investor understands? So what's the framework that you can follow? That's where these frameworks come into play: GRI, SSB, TCFD, and India's very own BRSR. These frameworks bring structure, credibility, and trust. Nestle saw a surge in ESG fund investment after aligning with TCFD. In India, BRSR is pushing listed firms towards global standards. ESG reporting isn't about bureaucracy, it's brand insurance. Always remember that. And as we move forward, this is the only lever that you have which can actually make a big transformation to your entire customer landscape. You'll not be only attracting new and newer customers, but you'll also have a global outreach. Now, let's talk about the implementation playbook. Let's talk about execution. ESG works when it's owned by business leaders, not just sustainability officers. Start by identifying material levers. Focus on what impacts your financials, energy intensity, supply chain waste. It could be many more. Then integrate ESG into operations. Build dashboards. Define and tie KPIs to leadership incentives. Infosys links ESG goals to bonuses. Tata Chemicals ties ESG to R&D. That's how you turn strategy into results. Let's recap. A very good example is about Unilever, $1.2 billion in saving. So sustainable innovation. Walmart, supply collaboration. via Project Gigaton, aiming reducing about Scope 3 emissions, Microsoft ESG transparency, and of course, the Infosys and the Tata Power story. Across industries, there's a common thread. It's all about driving short-term efficiency and long-term enterprise value. That's where the power of ESG lies. Let's wrap this up. Good to have you here today. And essentially, I just wanted to convey the power of ESG in driving all the good things into your P&L. So it's not only a checkbox, it's a growth strategy. Remember, that's the bedrock of why whatever you are doing on ESG. Companies that align sustainability with financial outcomes outperform on cost, valuation, and talent. Those who treat ESG as an afterthought risk being left behind. So here's what you need to do. Treat ESG as a business lever. Think what all you can do beyond your regular call of duty to have a sustainable engagement with your supply chain. Build investor grade matrix, because at the end of the day, as I was telling you earlier in a couple of slides before this, the future belongs to organizations that make purpose profitable. Thank you for watching. Thanks for joining me today. And if this episode sparked ideas, please do subscribe and share. More transformation insights coming soon. Stay tuned. Until such time, take care, stay safe, and we meet soon. Bye for now.